I want to bring in Kevin Green, senior markets correspondent, to help set up the action today. All right, KG, let's talk about yesterday and really what was driving the momentum it seemed to be in terms of equity market action. It really seemed that they were taking their cues from the bond market. Is that the right read through?
Yeah, it is. Obviously, there's a couple of things that actually did occur here, Diane, leading up to this little bit of a sell-off that we had yesterday. We had obviously a little bit of a consolidation, range-bound patterns that were kind of taking place. We had very low volume pretty much for last week and a half or so. And then you started seeing defensive stocks really outperforming the risk on tech sector as well as communication services. And yesterday, as we kind of tried to make some new highs here or try to break out and try to turn this thing around to the upside, we also had that 20-year bond auction. I think we talked about this yesterday. It's not a really popular auction by any stretch, but obviously we were looking at that as a gauge for how much demand is really out there post the Moody's downgrade. And we did not see a great auction at all. It was not really that good. And we had a really long tail to it, basically meaning that the high yield that actually occurred during that auction was a lot higher than what we actually saw being traded in the secondary market. And so that also obviously created a little bit more of a catalyst to the downside here. I think you also have maybe this budget conversation that's taking place in Congress right now. It looks like it just passed the House. Will go to the Senate. Is also maybe a little bit of a concern, and also probably pushing yields higher on the 10, 20s, and 30s. And once again, that's going to be kind of a little bit of a negative catalyst for the S&P 500. But if you kind of look at it, we've had a really decent run, a pullback, a little bit of a pullback and a retracement. I think is actually healthy for this market here. But we do actually have some technical structures that have been actually broken here. So that's something that we're going to have to try to recover here fairly quickly before we start seeing a lot more momentum to the downside.
I'll get into those technical structures in a moment. I'm curious to know what message is the bond market sending right now, especially when you make the point about the 20-year auction, which is not typically heavily subscribed. But what's the message that's being sent?
Well, I think the bond market's sending several different messages. The first one is maybe lack of economic growth because of policies that are kind of in place and just where we are at in the overall cycle, lack of monetary policy support coming from the Fed. So I think that's the first thing that's kind of moving yields up. Obviously, the focus on the deficit and debt to GDP ratios has also kind of pushed yields higher as well. And we still have the functional adjustment of the normalization of the yield curve in general. And I think that's something that kind of goes overlooked when people really talk about this space. I mean, we were in an inversion for a very, very long time. So now you're actually starting to see a little bit more of a normalization. And the longer duration assets, especially when you're looking at treasuries, really do deserve a higher premium compared to near term. And so that spreading out of the yield curve itself, I think, is also a normalization or readjustment or realignment here. And that realignment does create a little bit of volatility for equities. If you kind of go and look at past cycles, this type of situation, especially on the long end of the curve, can create a little bit of turbulence, but I think it's really necessary over the long term. So several different factors impacting the yield market, but we also have to just keep in mind at some point, yields will get to a level where buyers will want to step in and they feel like they are attractive. And so it's kind of like its own auction on a day-by-day basis. What is going to be the high yield in order for people to really kind of step in? But the White House put and the Fed put's probably still in place here, Diane. So I would not expect to see too much of a blowout on the long end of the curve here. It seems like they'll probably take some action.
Okay, and that essentially like what the President Trump has characterized as that big, beautiful tax bill that seemed to be a part of the pressure and stirring up the deficit concerns there. Is that the right read through in terms of the impact to the bond market?
I think it's a portion of that. I wouldn't blame the whole thing on the big, beautiful bill, as President Trump does call it, but it will, based on CBO estimates here, it will actually increase the deficit, and obviously it's going to put us in a situation where the debt to GDP ratio could continue to move higher. And then the question is, how do you fund that debt? Scott Bessent really, and what they campaigned on, is really trying to utilize the back end of the curve or the longer duration assets in order to fund the government. But with these yields at these levels that they are at right now, if they actually go through that plan, it'll actually get worse. So they'll probably still have to target the front end of the curve, which is something Janet Yellen did, and people criticize her for. But it seems like they're probably going to have to go down that route here if yields stay where they're at by the latter half of this year. So the big beautiful bill is a portion of this, but it will be adjusted in the Senate. And we'll see what actually happens once it gets kicked back to the House. It was difficult getting it passed. Let's see what the Senate does. The street really believes that the Senate's going to have a little bit more of a moderate approach when it comes to that bill. This back and forth between the House and Senate could actually maybe keep yields at a little bit of a cap level for now until we see what the final result's going to be.
And since rising yields tend to pressure equity valuations, what sectors are the most vulnerable?
Yeah, there's going to be a lot of them. If you look at any of the interest rate sensitive sectors out there, so if you're looking at, let's say, consumer staples for one, even though it could be a defense asset, utilities, because the treasury yields are going to compete with the dividend yields of utilities, which makes them attractive. And then you're kind of looking at the small cap space in general. The cost of funding is going to go up. And with the cost of funding going up, that could also squeeze margin. So there'll be several different areas in the market that's going to feel, the impact here. But once again, it's a normalization. We'll re-rate and then we'll kind of move forward. I just want to make mention, Diane, if you kind of notice, we talk about these treasury yields and we talk about the deficit at least once a year, maybe once every 2 years, it becomes a problem. And then it's not. And so we're kind of in this situation where it's a problem right now, but I don't know if it's going to really last in the headlines here over the next 3 months or 6 months.
Okay, all right. Well, certainly that move in the bond market now turning the S&P 500 negative for the year. But let's talk a little bit about one mover that we're watching today. Snowflake shares rallying this morning off the back of their latest results. Can you recap some of the numbers?
Yeah, actually, pretty decent reports, maybe outside of one metric for Snowflake here, but you did see product revenue coming in at $996.8 million. That was around a 26% growth on a year-over-year basis, exceeding the street's expectations. Also, the adjusted earnings per share came in at 24 cents. Street was looking for 21 cents. And when you're looking at their Q2 product revenue guide, that forecast exceeded the street's expectations, as well as their full-year product revenue guidance as well. They continue to see strong demand for the data analytics services that Snowflake is really offering here, and you are starting to see some meaningful growth on the AI portion or the AI investments that are going into the business, as well as the partnerships that they have with companies like OpenAI and Anthropic here. So the integration of AI obviously is seeing a little bit of tailwinds. The only thing that came up a little bit short was free cash flow, but this is still a still an early growth company for many, so you can kind of discount that. And it appears that the market is really appreciating the new leadership that is actually in the seat right now. We know that there was a lot of turbulence in February last year when their CEO left kind of abruptly, and the stock kind of took a hit. But it seems like the company's on the right track, and hopefully they're going to be gap positive here over the next couple of years. That would be the big goal.
Okay, and then really quickly, you mentioned some technical levels that we need to pay attention to, but for the S&P 500, still to the upside, are you looking for, well, I know before it was, you were looking for 6,000. Is it 5,900 to the upside? Where do we go from here to the upside and the downside?
Yeah, that's a good question. So 5,900 to the upside. I'm looking at 5,770 to the downside. If you look at the E-mini S&P equivalents, I believe we actually just hit around 5,800 for the SPX equivalent. We got fairly close. So let's see if we get a bounce here. But any type of breakage, you start filling that gap to the downside in the S&P 500, and that could actually create a little bit of volatility because there's not a lot of price discovery at those levels.
All right. Thanks, KG. That's our Kevin Green, Senior Markets Correspondent. Appreciate you.